Good afternoon. I'm here with Vishal Garg. He is the CEO and co-founder of Better.com, which is a direct mortgage lender that offers zero fees, zero rates, and zero commission on its loans. Let's start off. Just walk us through your business model and how do you make money with no fees?
Thanks so much. There's lots of ways to make money with no fees. The best way is to serve the customer at a lower price with a superior product. So that's what we do. We give consumers a approval instantly. You can get a rate quote in 3 seconds instead of 30 minutes, a approval in 3 minutes instead of 3 weeks, and even lock your loan entirely online in as little as 15 minutes compared to what it would take you at a traditional mortgage lender like Quicken or Wells Fargo or Chase. It'll take you 20 days to do that. And we do that all under the best price guarantee that we have, where we have the better price guarantee, where we'll meet or beat any mortgage lender's price by at least $1,000, or we'll pay you $1,000. So what we're building is the new platform by which Americans finance their home, and then working backwards from financing their home, also insuring their home, finding the best realtor for their home, improving their home, and refinancing their home. So that has helped us provide rates to consumers that are on average about 50 basis points cheaper. So on a $500,000 mortgage, consumers are saving $2,500 a year, which is quite meaningful to the average American consumer, as well as $3,500 in fees that they typically pay for a traditional mortgage. We're able to do that with zero. That has helped make us the fastest growing home finance company in America today. We're on track to do about $4.5 billion of loans this year, up from $1.3 billion last year. We're growing 350% year on year in an industry that is in secular decline.
Tell us a little bit about your competitors. Who do you think are the biggest ones in the market for you?
I would say in the context of actually a pure online automated mortgage experience, we don't really have that many competitors. Many of the other startups that started when we did in 2014, 2015 have exited the business or left altogether. And when we think about the average competitor that we have, is actually your traditional mortgage broker, right? It's a guy named Larry on the second floor of a strip mall who's got a bunch of realtor relationships and is friends with the title broker or the insurance broker. And those are the people that account for 65% of mortgages that are originated in this country. There are 500,000 mortgage loan officers that either are independents or work at places like Chase, Citi, Wells, or Quicken that effectively serve as the intermediation layer for life's most important transaction for Americans, for 32% of personal consumption expenditure, 60% of personal wealth. All of that is intermediated by people who on average are paid 150 basis points for simply taking a form and telling you what mortgage you qualify for.
And it certainly is a frustrating process. Myself have been through it several times, refinancing and buying. So what are some of the pain points that you are solving for the consumer? Why do you think those are the ones that are going to be the most effective?
Yeah, I'm so sorry about that. I started this company because I was perfectly happy. I was on 57th and Park and trading mortgage-backed securities and making spreadsheets compete against other spreadsheets. But I went to go get a mortgage myself. I was like, this is horrendous. How bad is this process? And we ultimately ended up losing the apartment that we were going to buy for ourselves to an all-cash bid because our mortgage company couldn't show up on time. I was like, if it's so bad for me, like a professional in Manhattan, how bad is it for everyone else? And so I think the first problem starts with who do you trust, right? So the entire process is effectively you meet some random person, right, at an open house and you decide that they're your realtor or your cousin or your father or your mother or somebody else knows a realtor who's a nice person and you go talk to them and then you need somebody and then suddenly somewhere along the process you realize, well, you can't even submit a bid until you can have a pre-approval letter. Right. So it's like, well, who's gonna give me a pre-approval letter? Literally, that's what the guy asked me. He's like, we're like, we'd like to buy this place. And he's like, are you pre-approved? And I was like, what is that? Right? And so we went through this process. And so who are you going, so which random person do you trust to, with all your rich financial data, over the phone who like, and then from there, who will take several weeks with that data and then email you back a PDF which has all your personal details on it, right? In an insecure email account. It's just like, wow, how are we subjecting ourselves to this crazy, bizarre process? So the pre-approval process is broken. Getting a rate, knowing what your monthly payment is going to be on a 7-1 ARM. Or what if you switch it to a 5-1 ARM? Oh, I'll be back to you in 2 days, right? Or I'll call you at an inconvenient time when you're in a meeting somewhere. So there's so many things about this process that are broken, and ultimately at the end, it's like closing. There's only one person paying all the bills at closing, right? It should be more like robbing. And literally, the expense associated with this transaction, on an average transaction, there's $9,000 that a major mortgage company spends to make a mortgage. And that's 800 pages of documents that are compiled that you have no idea what you're signing. So the lack of education, the lack of knowledge about what affordability is. And so we thought about this and I said, look, what do I really want? I want to walk into a house that I want to buy, pull out my phone, have it geolocate me, type in a few pieces of data, and get approved for a mortgage, and have it translate $300,000, which is some abstract price for 99% of Americans, into, well, this house is going to cost you $1,500 a month and $30,000 down. And that's how people consume housing. And so what we have built is just exactly that. You can go online at better.com. We're not live in New York yet, but in New Jersey and Connecticut, find a house and know exactly what it's going to cost you on a month-to-month basis for the next 30 years, and have the trust that it will be the lowest price, and that when we close, you're going to close with us, and we're going to fund you and then move you on.
So there are others out there, Rocket Mortgage, Blend, that are digitizing the mortgage business. What do you think that Better is doing that's different than what they are doing?
I think digitizing the mortgage business is like saying, I'm taking the Sears catalog online, right? That's something that should have happened in 1995, honestly, right? And what digitization means to most people is I'm putting an online form engine on top of a broken process. And what we think is different about Better is not only have we created the online form, which is anyone can do on Squarespace or Google Forms. I think that's what most mortgage companies, when they open up a website, it's like Google Forms plus compliance. But beyond that, we've actually automated the process. And by automating the process, we're now 80% of the traditional processing underwriting functions. At first, it started as a glorified VLOOKUP table where things were turning back to be true. And now what we have is a real matching engine between a consumer, their attributes, the property, and its attributes, which we're able to get from third-party sources instantly, and investors. We now have 30 plus investors on our platform, 8 of the 10 largest banks, many of the large insurance companies, credit unions, and the like, aggregating about $700 billion of liquidity, and we match the consumer's attributes and the property's attributes with the investor's criteria, and we're able to deliver an instant decision across the entire range of products and the entire range of pricing. And so what we've built is the first full-stack mortgage lender, the first loan origination platform in the industry that's brand new in 25 years. And in doing that, what we've built is a process where we're capturing all this data, and rather than having it be dead data on a PDF, having it be actually smart data that is empowering to the consumer.
Great. Is there a part of the process that you haven't cracked yet, or others haven't cracked yet that you want to?
Well, no one has cracked the notary. Right? So there still has to be a physical transaction. Someone has to show up at closing. There's a bunch of parts of the process that are regulated. The notary, was really interesting. You go into the history of the notary. The notary exists because in Europe, when the peasants couldn't read and they wanted to sell land between each other, you needed someone to read out the legal contract and then sign in blood, right? And so, that's what the notary does, and then the notary got paid for that, and that way we still have a notary, even though my phone can literally tell that I was there, it's me, right? So we think about, fingerprint permission and retina scan close, but regulation isn't up to that. There are other parts of the process like title insurance, which we have done an amazing job of automating. So rather than you be forced to go buy title insurance, which really you have no idea about, right? Literally, there is no Indian princess buried under this piece of property that my parents are buying, and that's not gonna. But when you think about that, you're like, hey, I'm ultimately what I'm just doing is taking this properties data set and verifying what it says in the 5 or 7 prior documents that are held at the county courthouse. Well, if I do that once, I never have to do it again, so can I compile that database and automate it, and so then the next time it's instant, it's free. So the disruption that is coming in this entire ecosystem, which is $35 trillion in size, is the fact that every single transaction was done bespoke, like one by one, where like 28 humans get together, make this 800-page PDF, and then they go away, and then these 28 humans gather again and make a new PDF, and then they go away. And what we're doing is making sure that that doesn't happen over and over again.
So now let's talk a little bit about the housing market and how it's slowing and not as robust as it has been. How is that affecting your business?
Well, it's really interesting. Like Americans, despite economic cycles, Americans continue to get older, right? Aging doesn't stop, and eventually people want their own home. They get sick of renting, and so in a bad year, mortgage demand is $1.5 trillion a year. In a good year, mortgage demand is $3 trillion a year. So considering that we're doing about $4 billion, we're at like 30 basis points market share, and we're hoping to be 1% market share next year. And then if we continue our rate of growth, eventually we'll be at 10% market share in the next 3 to 5 years. So it hasn't really affected us that much. And actually, in a environment when rates were going up, it was really interesting for us because when rates are really low, consumers are kind of less sensitive to rates. Like if everyone's getting a 3% rate, like, wow, that's a really low rate. I don't care if like Quicken is quoting me 3.9% and Better's quoting me 3.1%. I'm just gonna go with whoever I know. But like as rates started going up, it became affordability and expectations actually helped us because people really started caring about rates, and that helped us being the low-cost provider. And
what about refinancing? How's that going?
The recent decline in rates has set our refinancing business on fire. 90% of our process for refinance is automated, and in refinance where consumers want to get access to a low rate immediately. Like when you want to refinance, you kind of want to just be one and done and be done with it. So if you can get the rate versus like waiting on the phone for your guy from XYZ bank or from XYZ mortgage company to call you back with the rate, we found that there are utility and where like 85% of consumers literally get on the site, in 15 minutes they've locked their rate and they're good to go, right? And now they have security, and now they know that they're saving $500 a month for the next 30 years. That's just massive utility we're delivering back to the American consumer. We found that to be an amazing environment. Our business is on fire. Like we were up 40% month on month in terms of volumes.
Is it mostly just to get the lower rate, or are they also cashing out?
That's a really great question because 10 years ago, cash out refi, even rates were like 6%, was $1 trillion plus business, right? And instead, once the banking system really pulled back from like cash out refinance or home equity lines of credit, you had the birth of all of these other parts of the business in the fintech ecosystem, online auto loans, online personal loans, credit cards, all that. And Americans are now just again realizing that they've got a tremendous amount of equity in their homes, right? So the average American homeowner, we're now up to like 16 trillion of total home equity. And there's no reason, if you're planning on paying your bills on time, there's no reason to have a 10% personal installment loan when you can get a 4% mortgage, and of which the interest is tax deductible, right? And the terms are much longer. So we are re-educating and reimagining the power of home equity and delivering it to the American consumer in a way that they're used to now transacting online for personal installment credit. So our cash out refinance business is about 30% of our total business today.
You were saying, earlier when the rates were at 3%, it didn't matter as much, trying to be better than your competitor. You have LendingTree, you have a lot of platforms where you can compare loans. How do you feel like you're going to compete in that area?
If we are the lowest rate in every market that we operate in. So, if you go to lendingtree.com, after 5 p.m., we are the lowest rate all the time. So if you do want to shop for a home or a home mortgage, try us post 5 p.m. before 9 a.m. From 9 to 5, depending on the platform, like some platforms like NerdWallet and Credit Karma are terrific, LendingTree and Bankrate, because they sell the lead to multiple people And we're not as good as badgering consumers on the phone. Like, we won't call you while you're in the middle of a conference call over and over again. We basically don't compete on those sites during that period of time. But we love those guys. They're great partners, and we help the customers of those websites do a mortgage on their own time and at the best rate all the time. So, LendingTree is a great partner, but I think whenever we are on LendingTree, I think we have the best rate 98% of the time.
Let's talk about Amazon. They made a hire of head of mortgage lending, and so now there's rumors that's where they're going. What do you think about that? How can businesses insulate against something quite like that?
I would love Amazon to get into the mortgage lending space, because we doubt that they're going to actually get into the space of actually making the loans themselves. What they will likely do is figure out a way that a prime customer can get automatically decisioned and delivered a mortgage in as little as 2 days. Now, thankfully, we do it in 1 day for no marginal cost. And when they think about mortgages, they would probably more want to provide choice to the consumer. So I think, in the mortgage landscape, they'd be more concerned about if I was like LendingTree or Credit Karma or any of those folks where I'm a mortgage lead generator, then I think, the prime audience would be a group of people that may choose to transact within their Amazon stack than otherwise. But in general, what we have seen Amazon do is do mostly houses, right? So right now they're selling these $25,000 prefabricated houses. And I think, eventually they'll sell $50,000 prefab houses, $75,000 prefab houses. Now, your traditional mortgage company cannot do a $75,000 mortgage, because your mortgage broker, the 1.5% commission salesperson, and there's 500,000 of them, other than the ones that work at Better, of which there are 100, right? Those are all the other people, all the other 499,900 of them, right, are on commissions. And so they would much rather do a $500,000 mortgage, where they make $7,500 in commission, right, and then do a $75,000 mortgage or a $50,000 mortgage where they make only $500,000. So traditionally, the mortgage industry has actually struggled to service people who want to buy $50,000, $75,000 houses. We do not have that problem. So we are actively working towards figuring out ways to finance $25,000 houses. The benefit of a brand new ecosystem and infrastructure where the machine is doing 80 to 90% of the work means the machine doesn't care. It's the amount of work is the same to do a mortgage for $500,000 versus $400,000, because it's only a 4 turned into a 5. Like, the machine doesn't care. A person does, but the machine doesn't care. And so we welcome Amazon getting into home building and helping people buy $25,000 houses, $50,000 houses, $75,000 houses, and eventually more. I've said publicly in the past that, honestly, if I'm going to buy a house, I want a house that moves with me, right? So people have this connotation that homes should be stationary. And so for the longest time, all these mortgage investors are like, we're not going to finance a house that doesn't move. I was like, but we have global warming taking place, so we have people by the beach. If I want to buy a house on the beach in Rockaway Beach, I want to be able to move a trailer and move it over there, right? And so how do you finance that? So you need a new platform to finance that, and that's some of the innovation that we've been working on.
Great. You ready for overrated, underrated?
Sure.
Okay. Credit scores.
Overrated. The primary reason being that credit scores fundamentally are retrospective, right? Whereas consumption is prospective. And so in the context of a 30-year asset, you have to focus on debt to income and affordability much more than you focus on the credit score of the person, which is based on them buying $50 or $100 or $500 things, and here you are lending them to buy money to buy a $300,000 thing.
Okay.
Makes no sense.
Quicken loans.
Way overrated.
Fannie Mae.
Way underrated. The American government does an amazing thing for American homeowners, which is to take the fact that the US government can issue treasuries out to 30 years and have a really low cost of financing for a long-term credit instrument, and through Fannie, Freddie, and the GSEs, enable an American homeowner to buy a home and know that the rent's not going to go up for 30 years. That's enormous security that it gives to the American public, that they can then take the rest of their money that they make and put it towards saving for college, buying a car, doing all sorts of different things. And that wouldn't be possible without Fannie Mae.
Reverse mortgages.
Underrated. There has to be a way for people to get out of houses.
Yeah. And last, for the New Yorkers here, co-op mortgages.
Underrated, and until we make them better.
Great. All right, I think that's all for now.
Thank you so much.
Thank you. It was great meeting you,
so much.
talking with you.
Totally.